Howdy, Jacob here. Today we're looking at Terex Corporation in the machinery industry. 4.1 billion market cap, slightly higher enterprise value. Been around since 1933. They manufacture and sell aerial work platforms and materials processing machinery worldwide. Pretty low P right here. We'll see whether that. Okay, so highest operating margin they've had in the last 10 years probably is averaging 7 to 8%. So that's why it looks pretty cheap from that perspective. Growth is actually down from 10 years ago, but quite a bit up from even pre-COVID levels. Return on invested capital recently has been very high due to their inflated margins, but historically is actually averaging in the mid to upper single digits. Same with their operating margin in the upper single digit percent, gross margin high teens, low 20%. Balance sheet shows 371 million cash on hand with 620 million long-term debt. That has been quite a bit reduced since 2018. So it's good to see when a company does have a bit of debt that they're able to repurchase it and have historically repurchased it a bit. So their 5-year actual cash flow is probably about 250 million. So that debt figure is less than 3 years, their 5-year average. And even net debt, you're looking at maybe a year and a half. So not a lot of concern from that balance sheet. The free cash flow statement just show pretty much the same cash from operations and free cash flow from 10 years ago, with the use of cash really being share repurchases, reduction of debt. That dividend of 1% is maybe 20%, 20 to 25% of their 5-year average free cash flow. So it is a pretty small percentage of their free cash flow to pay in a dividend. So they do have room to grow that quite a bit. I know companies that get a little bit older have less to do with their cash. It does make sense to just pay it out in the dividends, since you have no way of reinvesting to get high rates of return. No way of, if the share gets cheap enough, that makes sense to buy it. But really just the acquisitions, you don't want a lot of companies to make acquisitions. A lot of companies are very inefficient with the way that they acquire companies, where they overpay for something that really just increases revenue. It doesn't really hit the bottom line. And that's really all I care about, is hitting the bottom line, hitting free cash flow, increasing it, making the company more efficient. So I don't actually mind them for as long as they've been around to increase that dividend. So let's start making some assumptions here. I don't think growth-wise we're going to see much growth here, so I will put 2%, maybe 13p in price-free cash flow, just under the market average, since I do think their growth is going to be a little bit lower, and I just don't see them reinvesting at rates of return that are really expansive. Margins, maybe 4 and 5, just put a little range on there to see where we're at. And then for the dividend, let's increase that 10%. I think that by the end of 7 years, will probably get them to 40% payout of their free cash flow in a dividend. And share change, 1% historically has been about 40 million. Offset stock-based compensation, you're looking at about 80 million in relation to cash flow. You're looking at 40%. I think that makes sense to me. So let's do 1% share reduction. So this leaves, at the end, this leaves about 20 to 40%, depending on immediately versus down the road, of money to make acquisitions, reinvest, pay down debt. And I think that maybe let's increase this 1.5%. So that leaves about 15 to 30%, depending on, again, into 7 years right now, to make acquisitions, reinvest, and reduce that debt. I think I'm good with this. There's just not a lot of growth out of them, even if they do make acquisitions and reinvest back in themselves, which we've seen historically. So I don't know. It just looks a bit expensive, and it's not at the price point that looks obviously cheap to me. But hopefully you enjoyed the video. Have a great rest of your day.